Hi, I'm Tom Elliott and welcome to another financial market update for Hodges Real Estate. Well, as always, there's bad news, good news, and I've got a few conclusions for you. Let's start with the bad news. Now, there's a new word that's been invented recently. It's called the Grexit, and it refers to the possibility that Greece might exit the Eurozone. Now, it is only a possibility at this stage. Personally, I think that in the upcoming Greek elections, the Greek people will retake their senses, if you like, and vote in a government which will ultimately do a deal with the rest of Europe. Secondly, Spain. The Spanish government has had to commit billions of euros to bailing out one of its biggest banks. It's called Bankia. Again, there is enough money in Europe to sort out these banking issues, but not if they get bigger and bigger. The problem needs to be contained now. Also, closer to our own neck of the woods, we've got a slowdown in the Chinese economy. Now, a couple of months ago, they said that economic growth for the year ahead would slow from 8% down to 7.5%. Some people think that could slip well below 7% at some stage fairly soon. Unemployment here in Australia, well, it was a bit of good news just a month ago. It fell to 4.9%, but I think unemployment in Australia is trending upwards, particularly here in Victoria, and could hit something around 6% within the next 6 months. And finally, real estate here in Melbourne in terms of bad news. Well, the clearance rate's been hovering at around about 55 to 58%. Anything below 60 to 65 means that the market is not really balanced. That is, there's a bit more selling than there is buying. So that's all the bad news around at the moment, and with all the convulsions we've seen in financial markets, it's not surprising that people are focusing on bad news. What about the good news though? Well, the Reserve Bank has just announced that it's cut interest rates again by 25 basis points on top of May's 50 basis point cut. And it's good news. It will mean that mortgages go down, although of course for people who live on the pension, who are trying to survive with the superannuation that they've saved up, cuts in rates aren't actually always good news, because of course they quite like the recently or hitherto quite high deposit rates we used to get. Of course deposit rates will come down as well. But anyway, rates will probably come down further in the next few months. The Australian dollar, well, it slipped well below parity recently. We got used to saying it was 100 plus US cents. It fell to as low as 96 cents just a few days ago. Right now, because the Reserve Bank didn't cut rates as much as what the market was expecting, the Australian dollar has rebounded. It's currently 97.5. However, I reckon it will slide further. It wouldn't surprise me before Christmas to see our dollar at around about 91 to 92 US cents. And that is, of course, good news for the Australian economy, believe it or not. We don't just want people to shop overseas and take holidays overseas. We want people from overseas to come and take holidays here. And of course, we want our exports to become more competitive. So a falling dollar is actually good news. And also, just turning back to the real estate market again, it's not just one market here in Melbourne. Now, any real estate agents will often be asked, what is the market like? It's a whole series of different markets. For example, near where I live in North Fitzroy, recently a house sold for the unprecedented sum of $4.2 million, a record high for that suburb. So it shows that there are people out there willing to spend, but from what I can see at the moment, the product absolutely has to be right. So what about the outlook? I think interest rates will fall further. Australia's rates are still far too high compared to the rest of the world. So if the government won't do the heavy lifting because it's committed to a budget surplus, the Reserve Bank will have no choice but to keep cutting rates until the economy starts to be stimulated again. Note always that a rise in unemployment is a terrible thing for those who lose their jobs, and the Reserve Bank needs to do what it can, especially when inflation appears to be well and truly under control. Real estate, however, I think will respond more positively in the medium term to cuts in interest rates. Now, people at the moment are very anxious to hold on to cash because they're just worried about the state of the world. But the problem with holding on to cash is that the return on cash is going down. If interest rates are cut, what you get, be it at call or at term deposit, is going to get lower and lower. As a result, eventually people are going to have to look at assets that provide a reasonable yield, that is in terms of an earnings yield, or in the case of real estate, a rental yield. And of course, they also want the prospect at some stage in the future of capital growth. The share market, as I said, is looking still a bit dodgy. As a result, I think property prices, with the caveat that interest rates have to fall further, but I think property prices will hit a level pretty soon where they prove to be very attractive, both to investors and to home buyers. Thanks for your company. I look forward to seeing you again next month. This is Tom Elliott with a financial market update again for Hodges Real Estate.